Welcome back to FinScribble. If you get a W-2 paycheck, you have probably stared at your tax withholdings in total frustration. But here is a crucial distinction most people miss. Tax evasion is illegal, but tax avoidance is completely legal and encouraged by law. The line between them is where wealthy individuals build massive fortunes, yet these same strategies are available to everyday earners. The tax code is not just a set of rules demanding your money. It is actually a massive blueprint filled with financial incentives designed to reward specific behavior. Most W-2 employees assume they are trapped with standard deductions and zero flexibility, leaving thousands on the table annually. Today, we are breaking down the exact legal tax reduction strategies your accountant rarely highlights, showing you how to reclaim your hard-earned cash without breaking a single law. Let's get started. One of the biggest misconceptions holding everyday people back is how tax brackets actually work. Have you ever heard someone claim that getting a raise will actually make them poorer because it pushes them into a higher tax bracket? That is a complete myth. America uses a progressive tax system, which functions like a series of buckets. Moving into a 22% bracket does not mean all your income is taxed at 22%. Only the money filling that specific top bucket is taxed at the higher rate, while your lower buckets remain taxed at 10 and 12%. This is why your marginal tax rate, the tax on your last dollar earned, is always higher than your effective tax rate, which is the actual average percentage you pay overall. Once you understand this crucial distinction, you can strategically lower your top bucket without fearing promotions or raises. Now, let's talk about math that surprises almost every W-2 worker. Why a $100 tax deduction is worth significantly more than a $100 pay raise. If your boss gives you a $100 raise, that money enters your highest tax bracket. After federal taxes, state taxes, and payroll taxes are subtracted, you might only keep $60 or $70 in your pocket. However, when you secure a $100 pre-tax deduction, like contributing to a traditional 401k or flexible spending account, you prevent that entire $100 from being taxed in the first place. You keep the full value working for you, avoiding the haircut at your highest marginal rate. In essence, deductions allow you to shield your income at its most expensive level. Understanding this financial lever shifts your mindset from simply trying to earn more to keeping far more of what you already make. What if losing money in the stock market could actually help you pay less tax? Enter tax loss harvesting, a strategy wealthy investors use constantly. When an investment in a taxable brokerage account drops in value, you can sell it at a loss to lock in a tax write-off. You can then use that capital loss to offset any capital gains from winning investments. But here is the best part for regular earners. If your losses exceed your gains, you can use up to $3,000 of excess losses to directly offset your ordinary W-2 income each year. Just be mindful of the wash sale rule, which prevents you from buying back the exact same security within 30 days. By replacing the sold asset with a similar fund, you keep your investment portfolio working while trimming your annual tax bill effortlessly. Most employees know about standard 401ks, but tax-advantaged accounts extend much further into your financial toolkit. Take the Health Savings Account, or HSA, which offers an unmatched triple tax advantage. Your contributions are fully tax-deductible, your investments grow completely tax-free, and your withdrawals for qualified medical expenses incur zero taxes. Even better, after age 65, an HSA acts just like a traditional IRA for non-medical expenses, giving you maximum flexibility. Next, consider 529 education savings plans for family growth. Beyond paying for college tuition or vocational trade schools, recent tax law changes allow you to roll over up to $35,000 of unused 529 funds directly into a Roth IRA tax-free. By strategically stacking HSAs and 529 plans alongside your primary workplace retirement options, you shield your wealth from taxes across every single stage of your financial life journey.
Finally, let's explore an advanced tax strategy called the Mega Backdoor Roth. High-earning W-2 workers are often phased out of making direct Roth IRA contributions, but if your employer's 401k plan permits after-tax contributions and in-service withdrawals, you can save massive extra cash each year. You contribute after-tax dollars beyond the standard limit, then immediately convert those funds into a tax-free Roth 401k or Roth IRA. This allows tens of thousands of dollars in extra capital to compound completely tax-free forever. Tax strategy isn't about hiding income, it's about intentionally using every tool legal frameworks provide. Take a close look at your pay stubs, check your company benefits package today, and start putting these smart legal tax strategies to work right away. You have worked hard for your money. Now make sure you keep as much of it in your pocket as legally possible.
As always, appreciate you hanging out today. See you in the next one.